Hello everyone, and welcome to another Placid video. Today, we're taking a look at a unique phenomenon that has recently occurred and affected all of our lives. Economic downturns are no stranger to humanity. Slumps, such as the Great Depression, triggered by the stock market crash in 1929, the oil crisis in 1973, the dot-com bubble burst in 2000, and the Great Recession in 2008, had profound impacts on individuals, businesses, and worldwide economies. The most recent recession is the one that we're experiencing right now thanks to the recent pandemic. The scale of money creation in the United States alone in 22 months from January 2020 to October 2021 has been unprecedented, with a staggering 80% of all US dollars in existence having been printed during this period. The total money supply ballooned from $4 trillion to $20 trillion. A worldwide surge in inflation began in mid-2021, with many countries seeing their highest inflation rates in decades. When the pandemic first hit, businesses closed, millions lost their jobs, and the economy took a rapid nosedive. To prevent a total collapse, the US Federal Reserve, often referred to as the Fed, assumed a pivotal role in mitigating the economic fallout of the COVID-19 pandemic through a monetary policy tool known as quantitative easing. This approach involves the central bank purchasing financial assets, typically government securities like bonds, from the open market. However, what distinguishes QE from traditional open market operations is the scale and duration of these purchases. The Federal Reserve creates money electronically, expanding the monetary base, and uses this newly created money to acquire assets. By doing so, they inject liquidity into the financial system and keep interest rates near zero to stimulate borrowing and spending, contributing to the increase in money supply. With borrowing costs low, businesses and individuals were incentivized to take out loans and invest, further boosting economic activity. First being brought up in the 2008 financial crisis and later during the COVID-19 pandemic, the Fed has employed QE as a powerful tool to provide additional monetary stimulus when traditional methods, like adjusting the federal funds rate, may be insufficient. While quantitative easing can be effective in the short term, it also carries risks and limitations. From March 2020 until the end of February 2022, interest rates were low, coming at around 0.25% due to the push the government gave during this difficult economic period. Consequently, today it is around 5.5%. During mid-2021, as the virus spread rapidly across the globe, governments implemented strict lockdown measures to curb transmission rates, resulting in temporary closures of factories and disruptions in shipping routes. With factories shuttered and the logistics network strained, the smooth flow of goods ground to a halt. This disruption rippled through various industries, leading to shortages of essential and non-essential products alike. From electronics to building materials, consumers face difficulties in accessing goods they have previously taken for granted. The scarcity of these goods naturally drove prices upwards, worsening inflationary pressures within the economy. As demand outstripped supply, consumers found themselves paying higher prices for everyday items, stretching their budgets and eroding their purchasing power. Injecting liquidity into the economy through extensive money printing, as mentioned before, served multiple purposes. Firstly, it provided immediate relief to businesses struggling to stay afloat amidst the turmoil, enabling them to meet their financial obligations and maintain operations. Secondly, it strengthens consumer confidence and spending power, helping to sustain and demand economic activity through stimulus checks. The US government sent out stimulus checks to many American households, and these payments were to help people facing financial difficulties due to job losses and businesses closures. They were a crucial support for families during tough times. The provisions of stimulus checks aim to address immediate economic distress by placing funds directly into the hands of those most affected. For many recipients, these checks represented a crucial source of income, helping to cover essential expenses such as rent, utility, groceries, and medical bills. In households where citizens have lost their job or experienced reduced hours, the arrival of stimulus checks offers stability and relief during the volatile economic period. As recipients infused their stimulus funds into the marketplace, consumer spending experienced a notable uptick. From retail purchases to dining out, the injection of these funds supported demand across various sectors, providing a much needed boost to business struggling with diminished revenue streams. Furthermore, the ripple effects of extended consumer spending extended to the employment dynamics as heightened demand encouraged hiring in sectors such as retail, hospitality, and services. The infusion of stimulus funds into the economy acted as a channel for economic activity, facilitating a gradual but detectable rebound from the depths of recession. In essence, the distribution of stimulus checks represented a pivotal component of the government's unique strategy to stabilize the economy and foster recovery in the wake of the pandemic-induced downturn. But in order to hand out these payments, the government had to print massive amounts of money, which is one of the reasons why inflation is currently significantly higher. One of the most pressing concerns is the potential for inflationary pressures to arise. When there is an abundance of money circulating within the economy, the purchasing power of each individual dollar diminishes over time. From groceries to housing and healthcare, the cost of essential goods and services can gradually escalate, eroding the real value of people's savings and earnings. Inflation therefore acts as a hidden tax on individuals and businesses, reducing their ability to purchase the same quantity of goods and services with the same amount of money. Moreover, inflation can have a broader economic implication beyond the individual level. It can disrupt long-term planning and investment decisions as businesses and investors grapple with uncertainty. The repercussions of increased money supply are becoming visible today, as inflation has surged to levels not witnessed in years. As a result, consumers are facing mounting pressures on their wallets as their purchasing power diminishes in the face of rising prices. When there is more money available, it can cause the price of things like stocks and real estate to shoot up way higher than what they're actually worth. This can lead to what we call an asset bubble. Basically, people will start buying these things at high prices because they think they will keep going up, but it's not based on their actual value. When we look at stocks, their prices can sometimes skyrocket way beyond what the companies are actually worth. This means that the value of the stocks becomes disconnected from how well the companies are really doing. For instance, a company's stock price might keep going up even if the company isn't making more money or growing its business. Similarly, in the real estate market, property value can quickly shoot up to levels that aren't sustainable. This means that the price of houses and buildings becomes detached from important economic factors, like how much rent they can fetch or how much demand there is for properties. So even if rental income or demand for properties hasn't increased, their prices may still rapidly rise, creating a mismatch between their value and their actual worth. Well, I hope you guys learned something new in this video. If you did, check out other videos on the channel. Subscribe and like on your way out. See ya!